Welcome to the Explainer. Right now, we are looking at a massive paradigm shift happening in global corporate financial reporting. For the longest time, sustainability reports were treated almost like an afterthought. They were just this nice-to-have document, totally separate from the rigorous financial data that actually drives global markets. But, well, that era is officially coming to a close. We're witnessing the rollout of a new framework that fundamentally rewrites how listed companies have to report the financial impacts of sustainability risks. It is literally a ticking clock, and businesses all over the world are sprinting to catch up.
Now, I want you to think about this number for a second, 30 plus. We're talking about over 30 countries that have already adopted or finalized this new regulatory framework. No way is this just some theoretical proposal floating around in academic circles. A massive wave of jurisdictions has already started enforcing mandatory disclosure this very year. The global momentum here is urgent, and the footprint of these rules is expanding incredibly fast.
So, here is our roadmap for the Explainer today. 1. The 2026 reporting deadline. 2. Inside the IFRS S1. 3. The 4 core pillars. 4. Global adoption and evolution. And finally, 5. Why this matters now.
Section 1. The 2026 reporting deadline.
Okay, let's actually walk through this staggered timeline, because it really shows you just how fast this clock is ticking. 2024, that was the starting line. That's when the standard's effective date officially kicked off for annual reporting. But then we hit 2026. A bunch of jurisdictions have locked in January 1st, 2026 as the mandatory effective date for listed entities. And then the screws really start to tighten. By 2028, assurance requirements in some markets will shift from just limited assurance to reasonable assurance. That means the data has to be incredibly tight and heavily verified. And by 2029, we're looking at full coverage of all listed companies in staggered rollouts, exactly like what's happening right now in Taiwan. Taiwan is a great example, actually. Companies there with capital above a certain threshold started disclosing 2026 data in their 2027 reports, and they'll hit full coverage by 2029. This is an immediate reality, not some distant future problem.
Section 2. Inside the IFRS S1. So what exactly are all these companies racing to comply with? Welcome to the alphabet soup of global finance, right? IFRS S1 officially stands for General Requirements for Disclosure of Sustainability-Related Financial Information. It was issued by the ISSB, that's the International Sustainability Standards Board, back in June of 2023. You're also going to hear it mentioned a lot alongside its companion standard, IFRS S2, which zeroes in specifically on climate. But IFRS S1 is really the overarching foundation here. It's the blueprint for how a company has to communicate about sustainability to its investors.
Now here's the absolutely crucial point. Under IFRS S1, companies now have to report sustainability risks and opportunities that could reasonably affect 3 major financial drivers: their cash flows, their access to financing, and their cost of capital. And they've got to do this over the short, medium, and long term. This completely changes the conversation. We're not just talking about carbon footprints in a vacuum anymore. We are talking about how sustainability directly impacts the actual money moving in and out of a business.
To put that into perspective, just compare the old framework with the new IFRS S1 approach. It's like night and day. Under the old rules, sustainability info was isolated, totally separated from the real financial statements. A lot of folks just viewed it as a PR exercise, to be honest. But under IFRS S1, that sustainability information sits seamlessly alongside traditional financial statements. It's officially a core financial metric now, treated with the exact same gravity as a balance sheet.
Section 3. The 4 core pillars. So how is all this new reporting actually structured? Well, it's highly organized around 4 core pillars: governance, strategy, risk management, and metrics and targets. If you've been following this space, you're probably thinking, hey, that sounds familiar. And you'd be right, because this structure was borrowed directly from the older Task Force on Climate-Related Financial Disclosures Framework, or TCFD. It creates a really logical flow. How's the company governed when it comes to sustainability? What's their strategy? How are they managing the risks? And finally, what are the hard metrics and targets being used to measure it all?
And when it comes to those metrics, IFRS S1 doesn't leave companies guessing in the dark. The standard explicitly tells companies to reference the SASB standards when they're picking their sector-specific metrics. This is a total game changer. It ensures that, say, a software company and a mining company aren't just copy-pasting the same generic sustainability fluff. They actually have to report on the specific data points that matter most to their unique industries.
Section 4. Global Adoption and Evolution.
Let's zoom out for a second and look at the broader global landscape, because obviously the world doesn't run on just one rulebook. Europe is a prime example of what we call regulatory convergence.
They have their own strict rules, the European Sustainability Reporting Standards. But check this out. They're pushing a 2026 revision specifically to make their wording interoperable with IFRS S1. The goal there is super practical. They want to align the framework so multinational companies aren't forced into this massive duplicate reporting burden across borders.
And the standard is continuously evolving to cover new ground too. Take nature-related disclosures. Back in April, the ISSB had to figure out how to handle those risks. Rather than just dumping a totally separate standard on everyone, they agreed on a very clear two-step path. Step 1 is developing an IFRS practice statement for nature-related risks. Step 2 is implementing that as incremental additions to the existing general requirements. It's a smart way to keep the whole framework unified while expanding what it covers.
But let's be real and look at the current adoption landscape impartially. While over 30 countries are completely on board, direct, wholesale adoption in the United States and much of Europe is still fairly limited at this exact moment. However, analysts are clear that momentum is absolutely building. More and more jurisdictions are signaling plans to align. This global standard is creating a huge gravitational pull, even in markets that haven't formally adopted every single letter of it yet.
Section 5. Why this matters now.
Okay, we've looked at the timeline, the rules, the global map, but what does this mean for the Treasury and finance teams trying to prep for this today? Consider this quote carefully. It points out that sustainability data is increasingly subject to the same audit scrutiny long applied to financial statement line items. That is literally monumental. You can't just estimate these numbers anymore. They're going to face the exact same intense, rigorous audits as your operating expenses or your revenue. Companies have to drastically rebuild their reporting infrastructure right now.
Which really leaves us with one vital question. Is your sustainability data actually ready for the auditors? The paradigm shift isn't just coming, it's here. The days of sustainability reporting being an unchecked PR exercise are completely over. IFRS S1 has made it a core pillar of global financial health. That 2026 clock is ticking loudly, and the time to build out your reporting infrastructure is right now. Thanks so much for joining me for this explainer, and I hope this gave you a solid, structured look at the massive changes ahead.